Should Americans own international equities in their portfolios? Hi, I'm financial planner Sean Mullaney. Let's discuss. So there's this great topic in personal finance, and it's this. Should Americans own in their equity portfolios the stocks and mutual funds of companies that are based outside the United States? And before we get too deep into this great question, let's just remember, this is not investment advice for you or any individual. Rather, this is an exploration of a great topic in personal finance, right? So some might say, hey, Americans should only own US headquartered companies. Others might say, no, there should be some allocation to companies that are headquartered outside the United States. And the way I like to start breaking this down is I like to look at credible polls, two extremes in the debate that are credible. And there are other polls than the ones I'll propose, but these are two I like to look at. One poll is 100% domestic equity allocation, no internationally headquartered companies. That poll comes from the personal finance classic work, The Simple Path to Wealth. It's a great book by the author J.L. Collins. And in his chapter 15, he proposes that U.S. investors really only need to own the equities of U.S.-based U.S.-based companies. He has several reasons for this, and look, read his book for his argument. Don't rely on my word, but I'll try to summarize it. His main argument in this regard is, look, U.S. companies are large. They have massive scope and scale in terms of they have economic activity across sectors, across geographies and jurisdictions. So if you invest only in U.S. companies, you get significant economic exposure to foreign markets, which is absolutely true, right? So that's his main justification for his position that U.S. investors generally should have 100% domestic equities, no international equities. Okay, so that's one credible poll. The second credible poll I look at are Vanguard target date retirement funds. I was looking at one recently, and they basically have a different poll. They say the domestic versus international equity allocation should be something like 60-40. So they're not at 100-0, they're at 60 domestic, 40 international. And so that's a second credible poll I look to when I try to resolve this debate. All right, so where do I come down in this debate? Well, I'll tell you, I come down much closer to the Vanguard poll than to the J.L. Collins poll. And I'll give you two reasons for that, right? The first reason that I find very credible comes from an observation financial planner Cody Garrett made on Twitter. I'm going to link to a tweet that Cody issued or wrote or tweeted back in March. He has this great chart that talks about the sector allocation between U.S. headquartered companies and non-U.S. headquartered companies. And it turns out the U.S. equity market is something like 25% tech. The non-U.S. equity market is something like 12.5% tech. So if you take that J.L. Collins approach, guess what? About a quarter of the value of your equity portfolio is in tech. And for some people, that might not be so good, right? Some people might say, oh, that's too much to have in the tech sector. One way to sort of hive that down, to sort of even that out a little bit, to reduce some of that allocation is, okay, what I'm going to do is I'm going to have 10%, 20%, 30%, 40% of my equity allocation in international. That'll reduce my exposure to the tech sector. Now, others might say, no, that's not a bug, that's a feature. I like that tech 25% allocation, so I'm going to be trend more towards the J.L. Collins poll, right? You have to do your own research, your own thinking on this point. But I think Cody makes a really valid point in terms of there's nothing that says that having 25% say in tech or that the U.S. allocation or balance of sectors is the right balance. So I think that's a credible point that Cody makes. The point I really like, this is a point that I myself make, and surprise, surprise, I find my points to be credible points, is this. I like the idea of diversifying my management, right? So if you think about U.S. headquartered companies, their CEOs, CFOs, boards of directors, their upper level management, generally speaking, come from an American background, education, and culture, and they come from a U.S. American management culture, right? Many of these people went to the same MBA programs, came up through the same consultancy firms, right? They have a very similar background, generally speaking, right? There's some diversity, but generally speaking, these folks have American culture and background in education. I like the idea of, you know what, I'm going to have some equities that diversify a little bit away from that American management culture, right? So when you invest in non-US headquartered companies, you're investing in CEOs, CFOs, boards of directors, upper level management that maybe went to school outside the United States, grew up in Europe or Asia, to a much lesser degree, Africa, South America, Australia. But I like this idea that we have some managers who did not grow up in the United States, didn't go to US business school. Now, I will readily concede that there are going to be some maybe CEOs of foreign-based companies that maybe went to 2 years of an MBA in the United States, right? So there's some bleed of US management culture into non-US management culture, but I still think there is some benefit of diversifying our management cultures when we're looking at equity allocations. So for that reason, I tend to be much closer to the Vanguard poll than I am to the JL Collins poll. What do you think? I think this approaching it by looking at credible polls, and there are other ones out there, I think is a good start to this analysis, but you got to make your own decisions based on your own research and your own analysis. I hope you liked this video. If you did, please smash that like button and subscribe to my channel. I'll see you next time.